So what a day. We had Meta earnings, Microsoft earnings completely blow out and we just sold off all day. Like this is the first time we've had a day like this in a very long time. But we're still above mid vamp. We're still holding it. So I am bullish, but this was definitely a counter momentum move today.
Absolutely. Now, I think a good way to sum this up is the day wasn't as bad as the candle, right? Like we only closed down 53 basis points today from yesterday's close. But the thing
Yeah.
is we opened up quite nicely and we had a whole range day of almost like 1.9%. So a really fat wide day, nice gap up and just sell throughout the whole day. And now what you have to look at here is, like you just said, we're over mid vamp, so we're still pretty bullish. But at some point, we have to expect a lower vamp gets tested. At some point, mid vamp is gonna snap. I'm not saying it's gonna snap right now, but it's going to snap. It's just part of how the markets work. Like every market has in an up every any market in an uptrend is gonna have a dip, right? And I think the approach here is not don't be bearish, but you need to be tactical about your positioning. And we spoke about this, or I wrote about this in the most recent ledger note, which is free on the website. Anyone can go to our website, market-radar.com, go to the ledger section, and you can read what I'm about to talk about here. But long story short, we expect higher prices as long as we're above mid vamp, which we are. But we also understand that dips can happen, and you want to be positioned in a way that you can handle the dips, especially if you're using leverage like we are. You do not want to get caught in a position where Nasdaq marks down 2% from here to lower vamp, which is at 552 on the Qs, and you're panicking and you're like, oh God, and you know maybe you're in futures too heavy or you're in options too heavy and you're basically liquidated. And that's not what you want to, that's another position you never want to be in. And that's not how you want to be handling this market. And I think that that's probably the most important uh, aspect or approach of where we are right now, because again, days like today are somewhat concerning. They could be erased tomorrow in the next couple of days and we can be at new all-time highs, no big deal. But I mean, you had two multi-trillion-dollar companies blow out earnings, and they actually held up quite well today, right? So like if you look at Meta was up 11% on the day. And then you look at
Yeah, Microsoft
Microsoft.
didn't hold nearly as well.
Yeah, but still up 3-4% on the day, right? Like if I would have told you Microsoft and Meta were up, 4% and 11% and the market closed down 0.5% after being, opening up over 1%. Obviously the rest of the S&P got sold. That's what happened here, right? And the Nasdaq. So these are things that you have to pay attention to. As simple as they are, they're not the most bullish signals, but I would call them bearish price action within a longer term bullish trend. Right? This is obviously a bearish day. When you have equity earnings like we were seeing marking up like the way that they were, we should have at least held some of the gain, maybe faded a little bit in the morning, recovered, and then pushed up to new highs into the close. Something like that would have been more ideal and more symmetrical with a real bullish and hot market. But things seem to be a little shaky here, but that's okay. And that shouldn't scare you. And that's the point of this conversation, right? You see stuff like this. Could we, like I say, right, like I said earlier, could we hold mid vamp, rebound, and just clip new all-time highs next week? Absolutely. Absolutely. But we could also lose mid vamp if this heavy price action continues and go for lower vamp, which would be healthy, normal, and expected. So if you're in a position right now where you've been basically buying every micro dip, because if you go back on Qs, right, every test of mid vamp has held since the trend went bullish in May or mid May. So you were actually a winner on any dip buy in a mid vamp over the last 2 months. And what I'm saying is we could see some sort of negative price action that does get us to lower vamp. And if you're leveraged in a way where you're pretty much max leveraging into mid vamp and hoping for bounces and you get liquidated, that is a very poor position to be into. So the way to sum up this little message here is we're cautiously bearish while still leaving our positions unchanged. We're using that caution and taking that caution into account and ensuring that we can handle any sort of like volatility or short-term negative price action if it were to arise.
Yeah, and at the end of the day, we are still in a bullish regime with a bullish trend. So
Absolutely.
if anyone has still cash on the sidelines, like this is the time to deploy it. Some at mid vamp, if mid vamp doesn't hold, some at lower vamp, really depending on the kind of position you want to take and how much risk you want to take. Obviously, if you don't allocate full size into mid vamp here, then you could miss out if it bounces off there. But also, if we do break through mid vamp and you want to wait it out till lower vamp, then you get a better position there. But dips are buyable in this regime.
Yeah, and I think a good way to sum this up is while I might sound bearish, my positioning is unchanged. I'm still long, still positioned for the regime, the trend. The models are the models. They're not going to get scared about, an engulfing candle. They're not going to start shitting the bed. But you have to understand that the leverage factor is very important because we could take a 2.5%, 3% drawdown on 3x levered. That'll be a 10% drawdown on your NASDAQ position easily, right? And you can get shaken out and we could reverse and go back up to all-time highs. And it wasn't the model that broke. It was your emotions that broke you. So you have to be very careful with how you navigate here and always keep your leverage at a level where, routine 2, 3, 4% market dips will not wash you out. That's the point of this message. But I think we can move on to the next topic there, right?
Yeah, let's talk about FOMC. So that was the big thing that happened this week. That's what everyone was waiting for, and it was very hawkish, actually. This was the most hawkish FOMC we've had in a while, I feel like.
Yeah, I think what made it so hawkish, right, isn't like in meeting terms, it was not significantly different than the prior few meetings, but it was hawkish against expectations, right? Expectations were really just baking or gunning for a September cut, and basically the soft signal that September was going to be a live meeting and that the Fed was going to take this meeting to prep the market to cut at the next meeting. And that pretty much did not happen at all. Powell walked that all back. Powell was very hawkish at points, pointing to the fact that, in so many words, Powell basically said, look, the economy's chugging just fine. Growth is doing just fine. We're seeing some stress in labor, but the labor market's still in balance because any weakness we're seeing in hiring, we're also seeing in firing. So essentially, you're having this labor market declining imbalance, which isn't necessarily problematic. Then Powell also reiterated that inflation is still above target, and the Fed still has a large degree of uncertainty. Now, there was some dissent at this meeting, so there were a couple of Fed members out of the 12, too, that voted against the hold and rather would have wanted cuts. All in all, the situation here is quite simple. The Fed is may have some internal debates. We may get a September meeting, a September meeting rate cut, but the odds have fallen and the market's taken some of that dovishness off the table. Now, is that problematic for equities? And I'm going to circle back to the Ledger post that I wrote on the website again. I don't think the market really cares that much about tariffs anymore, nor does it care about rate cuts as much as I think a lot of people wish it did, right? I mean, the effective tariff rates are not down significantly. They're still up significantly since the start of 2025. Yeah, they're gyrating between the estimated highs and where they are now versus the start of the year, right? But the effective tariff rates are still up significantly. The Fed is on a terminal basis, right? If we look at the terminal rates, the Fed is like no more dovish than they were pretty much all they're at some of their most dovish levels of 2025, but they haven't broken down, right? If you look at the implied forward curve of where interest rates are going based on the futures market, like we're still well above the 2024 panic lows, which was when the Fed was getting real dovish and when they started cutting rates because the SAM rule trigger. Like we're still way above that. So in terms of perspective here, if we go back to September of 2024, right? So like look at September 2024 when Nasdaq falls basically down to 440, right? Nasdaq QQQ is at 440, down from 500 to 440. Market's afraid there might be a recession. Fed starts getting a little antsy with rate cuts. Forward curve starts pricing in terminal below 2.75%. Things are quite dovish. Terminal now is 3.2%, excuse me. So terminal's up nearly 50 basis points off the lows. Okay. So terminal's up 50 basis points off the lows, which means the Fed is actually more hawkish than they were last summer. Yet since then, the QQQs are up 100 points, or the Nasdaq in general is up, something of the size of like 25%. So I don't think the rate cuts are as significant as, people are making them out to be. I think they're, weirdly enough, they're a sign that everything's okay the more dovish the Fed is, right?
Yeah,
Because if the
I
Fed,
think it's the floor moving that would matter. Like nothing really has changed in the floor in the past couple of months. And it's
right.
not the actual timing of when the cuts start that really matters. It's how that floor moves.
Oh, absolutely. That's a good way to put it. And as long as this floor is steady, um, constrained and just on a slow moving path, either up or down a little bit, it's not going to be problematic. When the floor starts crapping the bed here, like it did, from between July 29th and September 12th, the floor fell almost 75 basis points within a month and a half. So that's obviously problematic, right? That's showing that there's signs and the market's getting scared that there might be a recession, there might be some sort of stress. And as long as, we're still at the same range we were pretty much after the tariff releases, it's Liberation Day in April. The floor hasn't fallen and hasn't risen either. So I think the semantics of the Fed holding, the Fed not holding, are quite irrelevant. Like if we look at the terminal path, the Fed's 45% chance they cut next meeting in September, which will be after Jackson Hole, and it will be a set meeting. So they have the ability over the next 2 months here to really move, or a month and a half, really move the forward curve, because Jackson Hole plus the dot plots and all the Fed speak between now and then, plus the two labor market reports, which one will be coming out tomorrow, and the two CPI reports, the market can really move quite a bit between now and the next meeting. But ultimately, look, by this time next year, we're looking at about 3.5 rate cuts. So you can see here that we're not really, this is not a game of like drastically repricing. Like 15 days ago, it was 3.87. So we lost roughly a rate cut in the last 2 weeks. 2 weeks. This is insignificant over the next 12 months, right? Now, things become problematic when this starts accelerating lower, where the Fed is like looking at 50 basis point cuts or much steeper cutting cycle. I'm sorry, where they're cutting 25 basis points a meeting. We're still not even seeing that.
Well,
Right? Like,
do you see a risk at all with that floor actually rising? Not necessarily from rate hikes, but just pushing it out even further along the curve, because we are seeing the inflation index rising quite a bit and inflation swaps rising as well.
yeah, so this brings up another great point. On our website, we have a bunch of tools, and this is one of the tools I like to use a lot. It's the global inflation swaps, and I love to look at the 2s and 10s spread of inflation swaps. So a lot of people are familiar with the 2s and 10s interest rate spread, which is the difference between the 2-year yield and the 10-year yield. This is the difference between the 2-year inflation swap and the 10-year inflation swap. So if this value is negative, it implies that the 10-year inflation swap is less than the 2-year inflation swap. So you're doing 10 minus 2, right? That's how the spread's typically done. So if the 2-year is greater than the 10-year, it's going to be negative. And typically when the spread's negative, when the 2-year is at a greater value than the 10-year, it implies that there's a lot of short-term inflation or inflationary resistance in the market. The market's picking up a lot of inflation pressures in the shorter term, and it's alleviating over the longer term. So it's picking up some sort of hiccup in inflation, and this can mostly be attributed to tariffs. This started diving right after Trump won the election, right? This started going negative and really falling apart. And it bottomed on right after Liberation Day. Right before Liberation Day, it bottomed. So we have seen the bottom here post Liberation Day, and we're pretty much in this nice, firm negative territory. This isn't extremely problematic for inflation now, though. This does mean that there's net positive inflation impulses in the market. Inflation impulses have a wind in their sails. Okay, there's tailwinds for inflation in the market. But if you go on a much longer time frame, what you'll realize is how bad this spread blew out in 2022. Like we're sitting at negative 0.4. This went down to like almost 200 basis points in negative territory when the Fed was rapidly hiking. So this is problematic, but it's not crisis level that we were seeing in 21, 22. I think what this is basically telling you is there's a lot of uncertainty in the market regarding inflation. Therefore, for us to think the Fed is going to get super dovish here is probably a mistake, right? Like, to answer your question, yeah, like the Fed could easily push cuts off or delay or, space cuts out, and we could see the floor somewhat lift, but not due to rate hikes, just all it takes is 2 to 3 cuts to be removed from the cycle and you've pushed the floor up, right? So I think that's the big issue at the moment. And, as long as this is negative in the way that it's trading, the inflation swaps, it's hard to really say that the Fed needs to be cutting, because when the Fed was cutting like crazy, this was last year. This is where inflation swaps were last year. They look like, honestly, they were about to break out. They're about to take out the 2024 highs. This is when the Fed was really gung-ho about cutting all through here. And then the Fed did their final cut in December. And I think the swaps falling to negative territory were probably an underlying indicator that, look, the market has pretty much erased all disinflationary fears and deflation fears, and we're back to this fear of underlying possible inflationary pressures. And rightfully so, the Fed has been stalled on rate and policy since then, because the market's been telling the Fed, look, we're not too gung ho about this inflation coming back in full force just yet. Even though tariffs are transitory, I think there has to be some sort of reaction function here with a 6 to 7% deficit, that the effects from tariffs may be transitory, but if the fiscal stimulus is still hot and running even and potentially running even hotter, you run the risk that, like, the issue inflation never really was able to recover to target in the first place was a large deficit. And if transitory effects come and they go, but that deficit problem is still there, the Fed's going to be still sitting in the same chair of inflation is not going down to target, tariffs or no tariffs. And I think that's what the Fed wishes they could say, but they do not want to comment on fiscal policy at all.
Yeah. You want to talk about Bitcoin? So Bitcoin actually just broke mid-vamp. We'll see if it can recover before this candle closes, but this looks like this might be it. I don't know if it's recovering from this one.
No, I mean, look, let's just say we've gotten really lucky with Bitcoin, right? I mean, we're in from 94, 95, so we have a nice cushion here in cost basis wise and profits. We're not adjusting the position if we lose mid-vamp. We're not getting shaken out, none of that nonsense. It's just, you lose mid-vamp. I keep saying this and I'll continue to say this. If you lose mid-vamp, you just have to expect this type of price action. This sort of mid-vamp to lower vamp, choppy sideways, consolidating, base building price action. It's not over. It's not a bear market. It's not done for. It just means, look, price may actually consolidate for a lot longer than initially anticipated. Like, as long as we were over mid-vamp, every day I was expecting, look, one of these legs is going to break up and go to new all-time highs. That's what's going to happen any one of these days. And we failed, and mid-vamp was support. We failed to break below. And now it looks like we're going to get, a snap below, which means 112s, 113s could be in play as the next consolidating move. Very rarely do you lose mid vamp and just go, nuke all the way down to Momo, but that is possible in more prolonged consolidating phases. That's not something that, again, we position for. Like I said earlier, look, we're locked in long NASDAQ. We're locked in long Bitcoin. There is no, the price moving up or down 1 or 2% within a day is not going to shake us out. The regime needs to flip or the trend needs to flip. Okay, that's really what needs to happen here. Other than that, the price action is irrelevant. I think it resolves higher as long as the two main factors stay the same.
Yeah, like as long as we remain in this regime, a break below mid vamp, it's probably going to lead to chop. I doubt it's going to lead to a Momo touch. I think we'll touch Momo if we go into a risk off regime. But
Yeah,
otherwise, I think the dip is viable.
Yeah, it's quite rare that you get down to Momo, but I have to say, let me rephrase this. It happens. It's not common, but it does actually happen in bull markets and within risk on regimes. You'll have a periodic sell off in the market that maybe Bitcoin reacts more negatively to. Even the market, we've seen the market, the Nasdaq hit Momo in bull markets before. A good example was last summer or last spring in 2024. Nasdaq fell from 445, or Qs fell from 445 down to 412. And this was an intact risk on regime, the whole thing. So it's not uncommon to see moves like this. If the regime holds, these are actually great tactical entry points. If, you're trying to be a bit more tactical and you're not allocated, or you want to play the little leverage game where, for example, you may be unleveraged long Bitcoin, right? And you get a Momo move. Now one of two things, right? If Bitcoin goes to bearish trend, right, and the regime and the regime flips off and the rules allowing you have to get out of Bitcoin, it's time to go. Your safety points, you're a lot closer to the safety point, right? Now, obviously, Bitcoin's a little bit unique when in our model, we do not have the same risk parameters as we do with the NASDAQ. So it's not as sensitive. Momo is not as a sensitive indicator, but it's the same thing or theory applies. Momo, it does act as support. So in the NASDAQ, it's more sensitive. If NASDAQ goes bearish trend, it's completely out of the portfolio. Bitcoin can go bearish trend as long as the regime holds, that we're not in a risk-off environment. We will stay long the underlying. If you guys have any questions, feel free to reach out to us on X at the Market Radar, or go to our website at market-radar.com, where you can get our models updated daily and all of our signals published for everyone to see.